The options world is a very interesting world, but a very risky one as well. And you guys know that I like to invest long term and not day trade as I used to. So today we are going to talk about an option strategy that is kind of less risky than naked call or put options. Hello everyone, welcome back to the channel. If you're new to my channel, please consider subscribing and smashing that like button since it really helps the channel out with the YouTube algorithm. Also, I have a completely free Discord group chat, which the link for that is down in the description below. About 5 months ago, I posted this video talking about options trading or investing and the specific strategy I'm currently using to make some minimal passive income with my investments. Even though today we are going to talk about another strategy, today I would recommend any of you to go and watch that video. I will link it down in the description below. And watch it at least the first half of it as I do a complete intro to options, everything you should know, the statistics, the Greeks, what does in the money, out of the money, and at the money, and premium mints, which I think it is very important to understand before trying any option strategy. I will most likely do a quick summary every time I mention something, but that video is a more in-depth explanation, which I think it's very important. I also want to say that even though this is a kind of a safer strategy, there is also risk involved, and that is why, first of all, I don't recommend anyone doing any of this strategy with stocks that you are not willing to hold long term or you know nothing about their company, and you are going to see why I say this. And then second, never ever expect to become a millionaire with any of these strategies. And yes, we can make money. Yes, it's safer than trading, but still there is risk involved as in any other investment. Not wanting to scare anyone here, I just wanted to say this kind of disclosure before explaining anything, because I know that the options world is kind of weird. Let's just put it like that. But let's start. First of all, what is a cash secure put? It's selling puts that obligates you to buy 100 shares at a strike price if the underlying stock closes below that strike price on or before expiration day. If the stock expires above the strike price you sold at, the contract expires worthless, meaning you keep the premium you collected, which is the quote-unquote passive income we are talking about. So basically, there are two possible outcomes with this strategy. And I know that sounded really confusing, so in other words, selling a put option is basically when you are choosing to buy a certain stock at a certain price on a certain day. The difference between a cash secure put / selling a put and actually just buying a naked put is that when you buy a naked put option, you have the right but not the obligation to sell your stocks, while when you sell a put, you are in an obligation of buying 100 shares of that company, plus when you sell a put, you need a collateral, which in this case is cash, as you are going to buy shares. The best part of all this is that we get to collect a premium in the meantime with a cash secure put. Okay, so basically, as I said, you are gonna be creating a contract between you and another person that owns 100 shares of the stock that you want to buy, right? So you are person A and that person is person B. You're gonna create a contract selling a put option to person B, when that person will most likely sell your shares, his or her shares, to you, right? So let's say that the stock that you want to buy is currently at $15 per share, and the strike price that you are selecting for your put option is $10 per share, because you want to buy it for less amount of money than what it is worth right now. Because of this, you will receive a premium of $100 per share. With that $100, you can do whatever you want, whenever you want with that money. I usually reinvest it in that stock or any other stock, but if you want to withdraw it, you can withdraw it. What will happen is that as you want to buy 100 shares at $10 per share, you need to have in your account $1,000, because 100 shares times $10, that's $1,000, right? So that's the collateral amount that the brokerage will take out of your account until the expiration of this option. So let's talk about the two possible outcomes here. The first outcome is that the stock price is at $10.1 or above at expiration day, meaning that it will be at 10.1 or above. That means that your put option will be out of the money, meaning that will expire completely worth it. With this, it means that you will get to keep your $100, as I said in the beginning, which is the premium, but you will not buy the shares of the 100 shares of that put option. But then the second outcome here is that if the stock is at $10 or less, your put option will be in or at the money. What this means is that you already collected the $100 at the beginning, which is the premium, plus now you will get to buy 100 shares of that stock. So you remember this $100 that we were going to use as a collateral? Then you will buy the 100 shares with that $100, meaning that now you will own $100 of X stock, which you bought at $10 per share. This is why I said at the beginning that I would not recommend anyone to use any of these strategies with stocks that you are not willing to hold long term. Because what would happen if outcome number 2 happens and you bought 100 shares of that stock, but the stock price drops? You will be losing money in your position, and you have to be willing to hold that stock or invest more into it and average down your price. That is the main risk in this strategy. When you sell a put with a strike price of $10 and the stock dropped to $7, you still get to buy 100 shares of that stock for $10 each, meaning that you will be losing $3 per share right away. It is certainly difficult to know what will happen tomorrow, and if it drops, I would be buying the shares at a higher price, and I gotta be fine with that. And also gotta be fine if the stock does not drop to your strike price and you collect only the premium but did not buy the 100 shares and the stock went up massively, which is what a lot of people look for, because a lot of people are only trying to collect a premium. But if you want to really invest in this company, then this is not the best outcome either. Those are two main things I think you need to keep in mind when doing this strategy, as you never want to be worrying on this kind of investments, because as soon as you place that trade, that collateral will get pulled out of your account until you buy those shares at expiration date, if it expires in or at the money. So let's do an example here, because I know it is a way easier when we see how to do it, because when I started with options trading, I would kind of understand all the theory behind it that was explained in many YouTube videos that I watched or books that I read, but never got to understand how it worked 100% until I started doing it myself. And that is why I started with a demo account with TD Ameritrade that gives you fake money, which is my recommendation for anyone here. So let's say that you want to buy Wish, which at this moment is at $10.06 per share. It's completely cheap right now. I can't believe it. But let's get into options. So let's say that you want to buy Wish, but it's at $10 right now and you want to buy it for $9, right? So you go here to the tab that says trade and go to trade options. In here, you're going to see all the options that you have available, and you will decide which day you want your contract to expire. I want to be July 23rd. So in here, we can see all the available options. You have to make sure that you're selling a put option. So you have to click here sell and click here put and not call, because that's a different strategy. But when you are selling a put, then you see that the share price is at $10.03. Everything that's up here is in the money, and here is out of the money. At the money is right at the price of the share price. So let's say that I want to buy this stock at $9.5 per share, meaning that I will be selling this put. I will be collecting $23 in premium, as you can see here. So if we click it, I always like to see the volume and the open interest, which is kind of nice. So in here, I'm going to be selling one put that will expire on July 23rd at a strike price of $9.5. So what this means is that by July 23rd, the stock price of Wish is at 9.5 or below. I will get the premium that I will already collect today, plus I will buy 100 shares, meaning that I need to have $950 in cash today as a collateral until July 23rd, which I don't have right now. I have $465 available right now, but that's an example. If the stock is at 9.51 and up by July 23rd, it means that I will not buy the 100 shares, but I will collect the premium today. And at the end of that day of July 23rd, if I was not able to buy the 100 shares, then they will give back my collateral of $950 as I was not able to buy those shares. So if I want to sell this put, I just click 1 here, and you will see that my minimum credit is $25. I will click review here, and then you will swipe up, which I can't right now because I have not enough buying power at the moment, as I need $950 and I only have $465. I could deposit money in my account right now, but I don't want to sell this put today. So that's how you sell a put here. Obviously, you can see that more in the money, you will get more premium, but it's not worth it because you will be buying a stock at $11 per share when it's already at $10 per share. It's way better to buy it at $10 per share. It's $9.92, so it dropped. Time to buy. Okay, so whatever. Let me know in the comment section below what you think about this strategy, and if you would like more of this kind of explaining video. Be very careful with your investments and risking your investments. Hope you enjoyed the video. Consider subscribing and smashing that like button since it really helps the channel out with the algorithm. Thank you and see you next time.